Okay, so good morning, everyone. Welcome to the Macro Snapshot from the Macro Shop. We are Tuesday, January the 20th, 2026. We're waking up to a fairly strong risk-off kind of mood overall. Getting back, obviously, the US main markets were closed yesterday for Martin Luther King Day. But if we have a look here, we can see that the VIX has absolutely sort of jumped a lot, up to almost like 20. It's jumped about 5 handles overnight. In the US space, we see that the ES has continued to sell off, down about 154 basis points. NASDAQ down about 190 basis points. So interestingly, we're starting to get a little bit of technical damage happening to the charts here. So the gaps are being sort of filled down here, and we're pushing back. We'll get back to that in a second. But we're also seeing sort of yields up globally. We're seeing the dollar having a big sell-off. Here's the dollar index. You see the euro up, very strong green candle. We're also seeing gold spiking to new highs. You see gold up and obviously silver on the spot high. And then you can see that copper, for example, not joining the party in the risk off. So a couple of things are going on. I would say there's two main issues. First of all, there's the fallout geopolitically from Trump's sort of aggressive take on sort of Greenland. And we know that Trump is going to be over in Davos at the World Economic Forum. He's delivering a speech tomorrow morning. That's Wednesday at 8:30, which could be quite important to listen to it. So we've seen a lot of saber rattling sort of from Trump and the Europeans threatening tariffs, threatening to block capital flows, all kinds of sort of aggression. So a real sort of risk-off kind of sort of situation happening. We could see a little bit of reconciliation and a taco trade. That's going to be the interesting thing, which I'll get to in a moment. The second thing to talk about is what's been happening in sort of long-end bond yields. We're really seeing that the 30-year yields all around the globe have really been pushing higher. So let's now dig into a couple of details here. Got a few interesting things. So first of all, let's just deal with the geopolitics. Now we know that what Trump said about Greenland and whatnot, and that they want to buy Greenland, they'll do it the easy way or the hard way. A lot of quite aggressive posturing. The Europeans have been sometimes conciliatory, other times a little bit more aggressive, potentially talking about some reciprocal tariffs overnight. Trump was unimpressed by the fact that Macron declined an invitation to join his sort of so-called Gaza board of directors for the reconstruction of Gaza. Macron said thank you, but no thank you. Trump said, well, okay, well, we'll put 100 or 200% tariffs on champagne from France. This kind of back and forth. But really, what's to the point? We had this tweet here from Trump a few hours ago, actually about 5 or 6 hours ago. And you see, just not to go through the whole thing, but basically I had a very good phone call with Mark Rutte, the Secretary General of NATO, about Greenland. I agreed to a meeting. As I expressed, Greenland is imperative. There's no going back, etc., etc. So I would take that as a relatively sort of a peace offering in a certain sense from Trump, basically saying, hey, I went in hard to establish a maximalist sort of negotiating position, but I'm prepared to meet with people. So I personally believe that there'll be some kind of messy compromise. That's probably what's going to happen. Trump will not back down as such, but there'll be some, increased military sort of presence by NATO, et cetera, maybe more American bases. There'll be some, some kind of compromise. Now, we don't have that exactly yet, but I do believe that's possible. So if we go and look at a couple of charts, so that means, will we get the so-called taco trade today? So let's just look at something. Let me just go back to all of the charts here. So as I said, first of all, volatility is very high. So that's going to be a problem. But is that the overnight spike, and will volatility come in? So as I say, the VIX trading now at about a 20 handle. Let's keep an eye on the VIX. If that starts to fall, 19, 18% or so, that's going to be, a slight, it'll take some of the pressure off the stock markets. But if we look here, let's say global equity, we can see that over in Europe, we see the Euro Stocks 50, the blue chip, down a lot, down about 133 basis points. So that's following on from yesterday's open session. So, that could possibly stabilize. Maybe there's a bit more to go, down at about 57.60. To me, looks like a key level there. If we start, looking at, this is probably the moment to start pulling out a few Fibonacci levels here. So if we look at the Euro stocks, we can see that, really this first key point here, which coincides with this sort of recent sort of high at about 58.50, which is also the 38%. So that's the key level. Then you've got the next 50% fib down at about 57.85. There's obviously horizontal resistance there. And then, of course, the big one, I would say, a lot of sort of volume at a price down here at about 5,700, which also coincides with horizontal support and the 61.8% fib. But that's quite a long way away. If we look at that, that's probably like another, 2.5, 3% away. So I don't know that we're going to get that. So we could get a little bit of a bounce this morning if everyone calms down and turns down the rhetoric. If we also look at the DAX over in Germany, you see a big push down here. Again, similar kind of situation here if you start drawing out the fib levels. But what's also interesting, if you look at even something like the Kospi, which has been going gangbusters, that's starting to come down a little bit, not nearly as much as the European indices or the American indices, but global equity in general is down. Now, if we look at the ES, just to make that a little bit more granular, now what we've seen in the past, you can see here on the 20th of November, we did have this fib level being bought. Then we also had off the retracement, we had the fib level being bought on the 2nd of January. But what's interesting about this is that, again, if I break it down to a 4-hour chart, let's just bring it up here. We can see that this actually has broken the technicals because, as I was trying to say, that this fib was bought, this fib retracement was bought. But if we actually look at this latest sort of market move, you can see that here we actually gapped down. We gapped down on a Sunday night to below the 61.8, and that didn't actually hold. So not only did the fib level not hold, but the recent low didn't hold at 69.26. So this is something new. Not going to overly panic because at the end of the day, it's still in an uptrend. But we are starting to get a little bit of technical damage here, and you can see we're through the short-term fibs here. And so at this point, you've got to say. You have to start saying, okay, is it going to fill this gap? Maybe. There's not really a lot of resistance until we get down to 67.72. So just from a technical perspective, we had a tiny bounce, but I do believe that there's nothing technically to stop the market from going down another 1.31%, about another 90 points or 360 ticks. Is that possible? That's absolutely possible. If we look and just see if there's any sort of, moving averages supporting, we've broken through the 50-day moving average. Maybe the next sort of level down could be, let's say, the 100 EMA. So rather than wanting to test all the way down here, which is an important level, hold on, let me just put a nick box up, which is my little boxes here. So if we put these levels there, this is a key level down here, as I just mentioned, about the 6,600 level. Of course, not only is it sort of the recent lows from, going back, a couple of months. So that's a very strong resistance down there, but it also is going to coincide approximately with the 200-day EMA. So that's a key level. But before we get there, we do have a couple of other potential support levels. We have down at 67.72, which I just mentioned, which is the recent low. And then that also coincides approximately with the 100-day EMA. So I think that could be the next target. Now, of course, as I just showed you, there's also always the possibility of a Taco Tuesday, because Trump, as we just saw from that post a few hours ago, is starting to put the feelers out and say, hey, I had a good phone call, let's talk. And we know that Trump in the past, let's be absolutely clear here, his negotiating tactics or approach is to go maximalist. So he goes very aggressive, asks for everything, upsets the status quo. Then, the partners, his negotiating partners come in. There's a bit of a messy compromise. He'll probably ratchet it up one more time, the pressure, pretend to walk away, and then there'll be a final compromise. So is the market going to do that? It's possible. It's possible. But let's keep on watching the price action. As I say, without going into all the details, similar kind of situation here for the NASDAQ. It's gapped down. There is a recent sort of low at about 24,878. It seems to be about the level, which coincides just above the 100-day moving average. And then, of course, you've got more activity down a little bit lower. So that's really what's been happening in equities. But what I want to also talk about here is just the bond market. So let's just have a look at the 30-year bond market. Excuse me, having some Earl Grey tea this morning. And let's, first of all, just look at what's been happening in Japan, because that's really probably what's been kicking off everything. So if we look at Japan here, we just got from Bloomberg the charts here from the JGB to the 30. So this is the yield on the yield on the 30-year bond in Japan. Now we can see that that's been going up. Essentially it's been on an upward rise for the last couple of years. But just on this, this is a quarterly chart here, so you get really the big picture. But you can see it's really starting to rip a lot higher. And then overnight, if we just quickly throw it back onto the 30-year. Actually, I think I've got the 10-year here just very, very quickly. I've got the 10-year yield. You can see here that we're starting to get a little parabolic here. This is the 10-year yield, not the 30, but the same kind of principle. You see that's going much, much higher. So basically, we've got that going higher. Now, why is that going higher? Just very quickly, what's happening in Japan is that there's been a snap election called for the 8th of February, which is only about 3 weeks ago. And as part of the pre-election posturing, both the incumbent Prime Minister Takeichi, who's trying to sort of increase the majority of the LDP, but also the opposition parties, they're starting to sort of say to the Japanese people, hey, we'll cut this tax, we'll cut this tax. And what we got in the last couple of days was, I think, like an 8% sales tax on food, which Takeichi, the incumbent prime minister, said, hey, we'll probably sort of phase that out or get rid of that at some point. So less sales tax and less taxes are being put around as election promises. And the Japanese bond market is not liking that. It's saying, hey, you cannot be fiscally irresponsible. We already have a 240 or a 250% debt ratio of debt to GDP, which is the highest in developed economies. And so there's a sense in Japan that the governments are just spending way too much, they're issuing too many bonds. Now, what's happening is that the Bank of Japan is buying that, so that's pushing up the long-term yields. And if we actually look at that here, well, I'll get to that in a second, but just a general sort of sense here, let's just see what's happening here. So we have the nominal rates going up. So we have the nominal yields going up, especially at the long end. So we're getting a steepening of the curve. The BOJ, for political reasons or whatever, is not really tightening that much. So we're not getting the BOJ kind of trying to tighten interest rates. So we've looked here, we've got the Japanese JGB at 3.61. The implied inflation rates are around about 1.9% expectations, 2%, 2.5, depending on which inflation. There are a lot of different inflation measures. But essentially what's happening is that the nominal yields are going up. Inflation is ticking up a little bit, but not as much as the nominal yields. So that basically means that real yields, so the effective real yield, which remember is the nominal yield subtract inflation. So the real yield, what is effective in the real economy, is actually falling. So real yields are falling. And that is explaining why the Japanese yen, the Japanese currencies normally like to look at not so much the nominal yields, but the real yields. And we see that as the real yield is falling in Japan, that is putting downward pressure on the Japanese yen, which explains this whole problem about the weakness in the Japanese yen. They say, well, why is this a problem? Because Japan has been a source of global liquidity. What's been happening for many, many years now is that both in Japan, a lot of Japanese investors, pension funds, life insurance companies have basically exported capital looking for higher yield than was available in Japan. In Japan, remember, we had negative interest rates around zero for a long, long time. So a lot of these big institutions, but also domestic, just normal people, retail investors, were pushing their money outside into the world and essentially buying US stocks and government bonds from other developed nations and maybe crypto, riskier assets, buying a lot of the carry trade, buying for example, the South African rand, but especially, let's say, the Mexican peso. All of these things have been funded based on globally, providing liquidity globally, based on the premise that rates in Japan were low and were stable. Rates were low and they were stable. That is no longer the case. Rates are no longer stable. They're ripping higher. They're becoming unorderly. The 30-year yield has gone up 37 basis points. 37 basis points. I think in the last 3 or 4 trading sessions, the 10-year, I think, has gone up 20 basis points. So the point is that it's no longer stable, and also the yields themselves are going much higher. So this is creating some instability and putting upward pressure on this is going to put downward pressure on global liquidity, not good for liquidity. So the point I'm trying to make is that this morning, this risk off, it's a combination of Trump and geopolitics, but I think also we're getting a sense of ill-ease or a lack of sort of a comfort about liquidity, and this whole thing that what's happening in Japan is starting to spill over into other bonds. So let's have a look at, for example, the situation in Japan. So this is, the different tenors of the Japanese, so the different durations of Japanese bonds. You see here the 2s and the 10s have been pushing up. You see how they're pushing up. But what's interesting here is that we know that in Japan, the Bank of Japan is actually buying a huge amount of bonds. And there's even being talked that they'll start buying a lot of bonds as soon as tomorrow just to calm down the markets. But really, if you want to get a sense of how bond markets price future sort of fiscal lack of independence and inflation and whatnot, you have to go for the 10-year forward. That is basically what the market is pricing for, let's say, the 10-year yield 10 years from now. So it's really sort of the medium to long-term prognosis. It's sort of almost like the symbolic, what is going on in the medium term? What is the future telling us? Or what is the bond market telling us about the future? And you can see here that if you look at the 10-year nominal yield, which is the blue, you say, okay, it's going up. It's around about 2.5% or so. But really, if you look at the 10-year forward and the 10-year, 20-year forward, telling us what the market thinks really into the future, you can see it's ripping much higher. So the bond market is essentially saying, hey, yep, yields are going up now, but we actually think this is not going to get better at any time soon. And in fact, government profligacy and largesse, spending too much money, is going to be a continuing problem. Now, just to look at how fast these moves have been going, again, just from Bloomberg here, you got the chart of the move since 2 or 3 days ago from last Friday. This is the yield curve. So you can see these huge moves here. So the yellow line here is the Japanese yield curve going back 2 or 3 trading sessions. So at the front of the curve, twos, threes, fours, five, even out to 10-year, have we gone up 20 basis points? Yeah, we're going up. But you can really see that in the belly of the curve, the 15, the 20, look at the 30, and they have a super long bond, the 40-year in Japan. You see that that's gone up enormously. So you see here the curve's really, really steepening here. That's going up massively. Now, just while we're on it, I just want to get back again, pulling up from Robin Brooks, great economist here, a similar kind of situation, not only in Japan. And this is the point, all across the globe, long end yield. So these are all the 10 years, right? The twos, tens, and the forwards. If you look at the US, the same kind of thing, going higher, the forwards going up. If you look at Germany, ripping, the steepening of the curve. With Japan, we just spoke about France going higher, Italy going higher. UK going much higher, Canada going higher, Australia going much higher. Now, there are some kind of national differences. Obviously, the big one here is that Switzerland actually is the outlier here. So Switzerland is high, and the real yields, and this is a strong year, and this is why in Switzerland, the Swiss franc it continues to be the bedrock, the safe haven, not the Japanese yen anymore. It's the Swiss franc. So really keep this in mind here. You see here that the Swiss yields are actually going down, and the 10-year forward actually is much stable compared to even like Canada, UK, US, Germany, all pushing much higher. So globally, what's happening is that long-term yields are going higher, the forwards are going much higher, and even though inflation maybe is sort of a little sticky but not going crazy, essentially the real yields are getting lower. And so the issue, and that's weakening all the fiat currencies. So the point is that all the fiat currencies are being weakened, and that explains why gold and silver are doing well, and it also explains why the only reasonably strong fiat currency is the Swiss franc. So just keep all that in mind. Now, again, just talking about that, similar to the Japanese curve, this is now the US curve compared to a few days ago, the 16th. So when's that? About 4 days ago. So, and again, you're seeing this steepening of the curve. At the front end of the curve, just a few months, 1 or 2 years, not so much of a change. But as soon as you start going out to the 5-year or the 7 or the 10 or the 20 or the 30, you're starting to see those yields really pump high. So green is the live data snapped this morning. It's like an hour ago or so. And you see here that the live data is telling us that the curves are steepening. Now, remember that steep yield curves are not at all favored or welcomed by equity markets, especially things like NASDAQ, long duration kind of stocks. They do not like it. So we're really going to keep an eye on all of this. This is really the point to keep an eye on. Okay, so let's go back and look at a couple of charts. So again, we looked at the equities. And as I say, what we're trying to also figure out is just really what's going on with the equities and the bond relationship here. And you can see, for example, over in Germany, you see the front end of the curve. This is the daily chart. The charts went down, okay? But then as soon as, we're going the front end of the curve here, just down a tiny bit. So the 2-year down a little bit. You see the 5-year down a lot, the 10-year down a lot, and the books also a massive steepening. Now that's what I talked about because of the Japanese yields going up. But also it's this whole idea that governments are spending too much money, the geopolitical risk. Will the German government be obliged to spend more on infrastructure if the economies slow down? There's going to have to be more bond issuance, social programs. But then added to that, you also have the double whammy of geopolitical risk and increased spending on defense. So we're seeing defense stocks go up, but the general markets of equities going down, and we're seeing steepening. The front end of the curve is being relatively anchored because the market is saying, hey, if we have sort of trade wars with the US, maybe the global economy, the European exports will weaken. We might need to start cutting interest rates or at least supporting the economy. But on the other hand, we're going to have to sort of issue more bonds on the medium term and the long term to pay for infrastructure and defense and supporting social programs. So that's pushing up those yields, causing a steepening. So we're getting a steepening everywhere. Um, so that's the issue. Just quickly, while in European bonds, like the French bond has gone down, but not actually quite as much as some of the other ones. And that's just because the French budget looks as though it's going to be sort of passed. So that's could tighten some of those spreads. But let's just keep on going with the bonds here. And you see a similar kind of dynamic in the US. You see here the 2-year price of the bonds, the ZT down. But if we go to the ZF, the 5-year down a lot more. You look at the 10-year, look at this. You see some of these moving averages starting to push down. Then you look at the ZB, which is like the 15 to 20, a huge move down. And then the Ultra bond, which is the true kind of 25-year tenor, really just ripping below. You see all the moving averages. But let's just keep it on the 10-year to see where we can go. And you can see here we're in no man's land from a technical perspective here. So there's definitely more downside possible. We don't really have support on the 10-year until about 110.29, something like that. We're now down below all of the moving averages. We've broken recent lows. Similar kind of situation here with the ZB. We've broken lows, and you could argue there's some kind of downtrend support line down at about 113.06, which would also coincide with this. But it looks as though these levels down here at about 112.25, 13 maybe down around here, but that is still that's the local support, but that still indicates that the yields have we have maybe a point and a half to go. So we could see the more price pressure, which is going to put upward pressure on the yields, which is going to put ultimately a little bit of downward pressure on things like NASDAQ and maybe the small caps. So it's going to be quite an interesting day because we could have a taco impulse if Trump starts to, sort of talk in a reconciliation kind of way, or starts talking, not reconciliation, but let's say negotiation. But we really have to keep an eye on the steepening of the curve and that. Now, just in terms of everything else, we saw the dollar, big move downwards. Again, it's broken down through all the moving averages, it's broken down through all the fibs. What I will say here, just in terms of the fibs, is that the first line in the sand, so to speak, for the dollar index, were there. So as you can see, if we just look at this move, and I'll put this on a 4-hour chart to make it a little more granular, we can see here that the dollar was the big fib retrace was rejected at the 61.8, but now what we have just on this most recent sort of up move. If we anchored that on the 23rd of December, you can see here that we've broken through the 38%, the 50%. We're now basically at the 61.8% fib. We're just now in the pocket leading towards the 61.8 to the 65% fib, which typically we might see some kind of bounce. The bulls really, really need to step in here and push, because if we go through there, you've got to say that the next move down, minimum down to 98.16, and then we could even test all of these lows down to 97.8. But let's see what happens this morning. As I say, this is a 4-hour chart. Pretty key levels basically now, 98.3, 98.35, something like that. It can't really go below too much more. We're already dipping below the 61.8% fib. On the other hand, of course, opposite in the euro, again, we're getting a little bit of overhead resistance here at the 1.1742 level. Again, if we do the fib, similar kind of situation, but it's on the opposite side here. So we can see here that we're pushing above the reverse fib here. So this is looking very bullish. The euro actually more bullish. And if we look at, let's say the Japanese yen, what's interesting here is that the US dollar has gone down against the yen, but for the reasons we just spoke about, the yen not nearly as strong as some of the other currencies here. So, has the US dollar gone down? Yes, but it looks as though it's sort of underperforming things like the euro. And of course, if we were to look at the Swiss franc, you can see the Swiss franc, boom. No surprises there, just how strong it is. Obviously, all the moving averages pointing downwards. It looks as though it wants to test, this recent sort of support level at about 0.7875. So 7875 looks as though that's the next destination. Could it pause there? Probably, having a little bit of a pause. Now, just briefly on a couple of other markets here, energy. As I was saying yesterday, oil doing okay in this environment, weaker US dollar. Let's keep an eye on the inventories, but it's taking a little bit of a back seat here. Obviously, if there's any kind of attack on Iran, who knows? Will Trump try and cause a diversionary tactic by attacking Iran? It's possible. Nat gas has had a strong update, moving averages pushing over. Now, what's interesting about nat gas, a lot of that is weather dependent in the sense that a lot of Arctic air is coming down into the North American space. So that's obviously more heating days necessary. So you can see nat gas here, it's starting to break higher above at 61.8% fib retracement. So this is a bullish chart. But I would say the catalyst for this has been short-term sort of weather, colder weather coming in all across North America, continental North America. So really what we have to see is this going to be maintained? But often what you see in nat gas is that initially it could be a specific move driven by, as I say, specific weather patterns, but that could then sort of start to cause sort of some short covering and whatnot. So interesting to see if nat gas has more room to run up here. And then obviously, let's just finish off with the metals, which we mentioned earlier. Gold, what can I say? Having a bit of a pause here, but has been pushing higher. Can it get to the top of this sort of channel extension? Yeah, I mean, but it is getting there. Obviously, it's overextended in theoretically, but overextensions can always continue to move. But I would just point out to everyone that if we look at some measured moves, for example, this kind of measured move, there's more room to run. And if we look at a shorter term measured move, let's say from here, for example, you can see that, we are getting there, but it's not, it's a similar kind of situation here for silver. It's very easy to say, oh, it's overextended, it's done. But the reality is the measured moves here, just from a technical perspective, the Fibonacci extensions, if we look at silver, and I'm just measuring them out here, as you can see, they go well above $100, 102, 104. So the point is here, can silver, collapse today? Of course, everything's possible. And obviously there's a very high volatility, but the reality is that from a sort of a technical perspective, there is potentially more to go. So even though it's, overextended on something like the RSI, there is definitely more potential. Similar kind of situation here with platinum and palladium, not quite joining the party, but let's see what they do today. And the interesting one is copper, which has not joined the party. Obviously, geopolitical risk, worries about trade tension. That's quite logical that copper is not joining the precious metals party just at the moment. And let's have a look at our friend BTC. Interesting. Definitely interesting level here. For the bulls who want to come in, this is a great level because you've got support at around about the 90,000 level, 90,500. But the reality is the moving averages are pushing downwards. If we want to go with the measured move logic, we could do something like this and say, where could this go? Just from again, purely technical perspective, you could argue that, down to around about, 89,500 is an interesting one because that's starting to be the first measured moves here. So, technically, can it move down more? Yes, it can. On the other hand, if we do the shorter term measured move, which would be here, you see that some of the shorter term measured moves, which are just measured here on the chart, they do go down to around about 89 to 90,000. So definitely Bitcoin, has had a fairly, big extension towards the downside. Is there sort of horizontal support around about 90,000? Yes. Is 90,000 one of the completed measured moves levels? Yes. So that is an interesting level there, potentially for the bulls to step in. That's quite an interesting one there. Okay, I've spoken way too long. I will stop there. So have a great day, guys. Let's keep an eye, as I say, things happening in Japan, the long-term yields in general. Let's keep an eye on the VIX to see if the VIX comes down a little bit. If we get the VIX coming down, if we get the yields coming off highs, and if we get some kind of talk about meetings and, sort of positivity coming out of Trump and all the meetings happening on the sidelines at Davos in Switzerland, can we get the taco trade, yes, I think we can, because there's more room. There's a lot of room for the equities to bounce. But on the other hand, as I said, there's plenty of room on the downside as well. So it's going to be quite an interesting day. Let's see how it all pans out. Thanks very much. We'll be back with the macro snapshot from the macro shop tomorrow morning, same time. Thanks very much. Have a great day.